Hello, YouTube. Justin here. After a very tough week of trading, we are likely headed for an even tougher week next week as the stock market faces its final boss, or Jerome Powell, when the FOMC decides on Wednesday whether or not they're going to have rate liftoff, what that's going to look like, and where the stock market's likely going to head. I don't know about you, but I keep telling myself on these weekend videos that if you don't want to get chopped up, don't trade. And I had a pretty tough start to the week this week. I was able to recoup some of the losses, but I am closing the week out red. So I think my goal for this next week and my goal to present to you is, regardless of our emotions, because I've never actually traded through what we're seeing in Europe right now. I don't want to say the bad word. I've never actually traded through this. I've traded through a brief period in 2008, some of 2013, but I think that my emotions are getting the best of me. And I want to try to understand exactly what the charts need to see and the fundamentals for us to be bullish, for us to be bearish, and why we potentially want to wait until the later part of the week to see what's going to be happening for the week ahead. The reason why I really want to focus on that this week is because we took a brief pause to explain the bull thesis last week, and maybe it was a little bit premature in sharing that, but we did get our massive snapback on Wednesday when QE ended from the Fed and we got $4 billion in treasury bonds that were bought. However, with that brief pause, we can now see that we are still in a dominant head and shoulders pattern with a key area here, which is going to be that 400 gap, which we set roughly a year ago, 400.67 to be precise. That gap is something that everyone is watching, including myself. And I have a preview in terms of how we can go down here, actually fill that gap, and then decide what we're going to do at about 400. What I'm talking about here is QQQ, which stopped going up, started going flat, and then started pointing down. So right now, QQQ is no longer going sideways, it is actually going down. And we can see that that blue funnel lower here, which we're looking for on QQQ, is likely going to get dragged lower from QQQ because, again, tech leads SPY. So if technology is already in a bear market, not just a correction, and we're seeing that S&P is now closed its first technical week below 432, the S&P is now also officially inside of that correction territory. That's the thing we want to ask ourselves this week. So as we look forward as well, there's also been $10 trillion and counting deleted from the global stock market so far this year. I don't know about you, but $10 trillion seems like a very big number to me. We were sitting at roughly 94 trillion at the all-time highs, and right now we're sitting just below 84 trillion. That's a lot of money. It also matters because as we look forward to this next stage of the cycle, here we're being told that, again, it has been a bad year for equity so far amid a commodity crunch. So what's been doing well? Oil, commodities, and gold up by 44, 38, and 5%. The US dollar is up by 2.4% year to date. And then we look at bonds, which are currently red year to date. We got government bonds, high yield bonds, investment grade bonds down 4, 7, and 7.2%. The things that are notable here are what is the worst. The worst decliners are stocks and Bitcoin. And like I mentioned before, stocks now closed their first official week in correction territory from the S&P 500 closing below 432. So what we want to ask ourselves is, if QQQ started by going into a correction and then went into a bear market, is S&P going to have that same fate? And there's a chart we're going to show a little bit later, how we have BTC versus ES, which is still my template for where we're going to be going. It provides a bull and a bear option. I'm also trying something new this week, so if you're enjoying it, please make sure to smash a thumbs up, drop me a comment, and let me know what you think. We're going to be combining both videos into one, and this section here is going to be new as well. I'm going to provide you with my base case in terms of what I think is actually going to happen, not just are we bullish, are we bearish, actually giving you the bullet points in terms of what I think we're going to do for a base case or the default. Not that I'm Nostradamus, but this is my best guess after going through and doing all my research. I'm going to circle back and talk about this one a little bit later. What I want to do first is preview the rest of the show. So again, going through here, we also have an agenda. So what I'm trying to also do is to provide you with an outline for what we're going to talk about during this video. We're going to talk about the base case. We're going to talk about how the S&P is closed, the weekly, in correction territory by closing below 432. Is a recession ahead? We got two new news articles to go through. We're also going to be specifically looking at the 2s, 10s, which is the 2-year note, and the 10-year note, which are set for inversion, which is usually a telltale sign or a preview that a recession is imminent. The fear and greed index, we're going to look at three things notably, which are down 40%. The Ruble, ARKK, and DIDI. Ruble is down 40% year to date. ARK is down 40% year to date. And DIDI is down 44% in a single session. We're going to talk about QQQ, which just formed a daily death cross, and what that looks like with S&P, set for that same death cross happening soon here. The DAX versus SPY. We're going to talk about ETFs. We're going to talk about the trillion-dollar companies. We're going to talk about OpEx, monthly and quarterly. And then we're going to talk about BTC versus ES, and we're going to talk about the quarterly close. Moving forwards, again, I mentioned this last weekend, and I apologize if this was a little bit premature. We saw the massive snapback on Wednesday when the Fed did their final day of QE and bought $4 billion in bonds. That was a pretty massive reversal, and I think that I'm still pretty confident that the end of the month into April is going to be the reversal. So I'm going to talk about this one a little bit later. And again, sometimes I'm wrong. I am not Nostradamus. I am not perfect. I do make mistakes. I'm a human being. If you can appreciate that, smash a thumbs up and drop me a comment. Have you ever made a mistake? And if so, what was it? All right, same chart there. I'm going to go through my base case after I get through the rest of everything else here. I think I duplicated this slide a few too many times. So again, you can see here that we got bears in control. I think the 400 gap is going to get filled. We got OpEx to quarterly close chop. April, I think we're going to see relief. Rally on Russia and Ukraine. We're going to go through the bull and bears are going to fight it out for direction after that. And I think the bears have the edge. I'm going to go through point by point and explain each one of these in a few minutes here. Just stay tuned. Two more things here. Again, what could go wrong? We talked about Jerome Powell and how he has a big decision this week. So this is based on an economist survey from Bloomberg. And here it says that 23% say the Fed will tighten too slowly. 28% will say the Fed will be too aggressive. And 49% see those as equal risks, which means Jerome Powell is definitely on the high wire and trying to do a balancing act, which could be quite difficult because there's a lot of uncertainty right now. What the stock market loves and craves is certainty. And right now, we just don't know. Goldman Sachs is also saying that the U.S. recession risk is at a high of as high as 35%. The chances of recession in the coming year are broadly in line with the 20 to 35% odds currently implied by models based on the slope of the yield curve. So again, that yield curve, I'm going to come back and talk about that a little bit later. This is just a preview. The key dates for this week, again, trying to also make the slide a little bit cleaner, spacing it out. If you enjoy it, again, smash that thumbs up, subscribe to the channel, and drop me a comment. The most important data point for this week are going to be the ones that are obviously more visible, the ones that are bolded and underlined. If it's underlined, it's the most important. So Wednesday, we got day 2 of the FOMC, where we're going to hear about the summary of economic projections. We're going to hear about the rate decision. We're also going to have that Q&A with Jerome Powell. On Tuesday, we got day 1. On Thursday, we got European CPI and Christine Lagarde speaking again, remembering that the central bank in Europe made a notable note going a little bit more hawkish in light of the current inflation. So if that data supports it on Thursday and we hear more hawkish commentary from Lagarde, that's likely going to lead to more downside. On Friday, we got options expiry, and there is massive flow. If the bears are going to get paid, they're going to want to drive this thing down by Friday. And then finally, we got the end of the quarter on Thursday, the 31st. And as you're probably going to note, we are combining both videos that we were breaking out separately before into one video. What I'm trying to do is not just make a video for the sake of making a video. What I want to do is provide dates like this, but then tell you how we can actually action those. So as we get to the technical part of the video, I'm going to tell you why these key dates matter and what we're going to be looking for. So there we go. Moving forward, again, why bull or bear? So again, for me, the reason why we would be bullish is because the monthly bottom is in, which means that quarterly bottom is in. I don't know right now, right? It's looking a little bit more bleak. The peak hawks and peak geopolitics. I think we're maybe at peak hawkishness. I don't know if we are at peak geopolitics. Again, we're driving based on headlines, and the headlines right now, we're just not all that pretty. What else? Well, I think it's a self-fulfilling prophecy where the average person is now looking to the market, and their inflation expectations are the worst they've been in 40 years, which means that some of the demand side is likely going to be coming off. And the easiest way to try to understand this, again, not that I'm an economist or that I know everything, but pretend that after you get your paycheck, you normally have $1,000 left over. So you work for 2 weeks, you get a paycheck for pretend $3,000, $2,000 pays for all of your expenses, and now you got $1,000 left over. And normally, when you fill your gas tank up, it costs you maybe $500 a month. If now, again, using nice round numbers, it costs you $1,000 to fill your gas tank up, you only got $500 left over, which means that you're either going to have to spend less money on other things or drive less. That is where a very high price can actually remove some of the demand. I think a lot more people are facing a scenario where they're trying to decide whether or not to keep the lights on or to eat because they're not making more money, but everything costs more. So that is where we're seeing a demand shock, which is not something that the Fed can control. They can't control that at all. When prices get too high, people just stop participating. The bear market scenario was that the wheels are well in motion, we're at a peak cycle, and the inflation narrative is the base case right now, which is what everyone's talking about. In terms of surprises, FOMC, geopolitics, OPEX, and European CPI in order of what I think can move the market. All right, now let's go through my base case. And again, right now I'm going to provide just an overview. And then when we get down to the bear and bull scenarios, then I'm going to go through the agenda and talk about specifically what would be bullish for me, moi, Justin, and what would be bearish for me. So let's go through. The bears are in control. As I noted before, the bears are in control because we got a bearish pattern. It's not rocket science. So we look here, we got a head and shoulders, and we're below the short-term price, which is the 50 weekly. That is bearish by definition. Not only that, we got a nice solid downtrend. So we got a nice solid downtrend with a funnel. And in addition to that, we even have a template from QQQ where once we start going down, we continue to go down. So what we would need to see to invalidate this pattern is for a weekly higher high. It tried to do it last week and then just puked. Closing at the low of the week means that investor confidence at the weekend is quite low. It just barely hung on to 420. So that's my base case. My base case is also that the 400 gap is going to fill. The reason why I say that 400 gap is going to fill is because, again, back to roughly this time last year, March 29th of 2021, going into April, we left a hole right here. Oh, that's right. We left a big old hole at 400.67, which is going to be the green number you can see over here. So what I think is going to happen is that we're going to continue down into here. We're going to find some kind of relative support, and then we're potentially going to go back up after. So now I think that it's all but a guarantee that we're going to fall down to at least retest the 410 low, 410.64, if not all the way down to 400.67. They really love that 0.6 and 0.7 area, by the way. 400.76, 410.64, and 400.67. So let's see what these bears got. I think this is going to happen because of the QQQ pattern, which shows us here that, again, once we fall below the green line, we usually go all the way down to self-fulfill. We also have some weakness, which is coming in from the trillion-dollar companies. So in the last 1 week, again, everything's red, but again, technology has got some pretty big red blocks. And the reason why that matters is because when we look at year to date, it's double-digit declines for Apple, double-digit for Microsoft, double-digit for Amazon. Tesla's at almost a quarter red. Google just eking out less than 10. Facebook down by 44. Oh, geez. This does not look nice. Does not look like it's a bull market to me. We're going to go through the technicals for all the trillion-dollar companies a little bit later, too. Third thing is the OpEx and quarterly chop. So we have OpEx coming up on Friday, which is options expiry, when we see all of these options expire for S&P and QQQ. So what that tells me is that we're likely going to see continuation in terms of the chop. And the reason why I say that is because when I look over here at the options chain, we can note here that what I'm looking at is going to be these areas. I'm looking specifically at, I'm going to show you actually how I take my normal screenshot. This is inside my TD dashboard, which is my broker. I don't really trade with them anymore, but I really like the way their chains are laid out. So I'm going to take a shot here. This is going to be showing us the March 18th expiry. I'm going to ignore all the other chains because, frankly, this is the one that matters here. We're also only going to look at the 16s, which means we're going to be looking at 8 strikes below and 8 strikes above. So again, 16 just means there's 16 total strikes, which means that, again, we're looking at 8 below and then 8 above the current price. So we're going to look here. And what I want to note is just that, right, we have the first thing I note here is that there's almost no open interest that's above 10,000 for calls. And into Friday, when we closed at the low of the week, no one was excited to buy calls either. So what that tells me is that there's a lack of bull enthusiasm. When I look over to the bear side, we got 60,000 in open interest at 425. We got 82,000 here at 420. We got 66,000 here at 415. And then we also have volume at that same strike, which to me means that not only are they interested in that area, they want more. They want more 420s. They want more 425s. So these numbers are big, right? These numbers are large. And because they're so large, it tells me that this is not very pretty for the bulls. And I think that we need to try to understand exactly what this all means and then move forward. So this is not pretty. It means that the bears are quite motivated. And because everything expires on Friday, if they're going to try to go for it, it's likely going to be here. Next thing I want to look at is going to be the SPX quarterly expiry, because this is where the index is going to be rebalancing at the end of the month and trying to understand what that means. So first thing I want to point out here is just the 4,200 strike. And right here, we can note that we have a massive flow. We got about 16,000, 17,000 here. Remembering that because this is SPX, it's 4,200, not 420. This is the equivalent of 170,000 puts right here at 420. The reason why it also matters is because I'm actually just going to pull up these screenshots here. Actually, no, I'll just show you guys. So let's go here. Let's go to all, which means we're going to look at all the strikes now. And I'm noticing two things. I'm noticing that we got a let me just actually show it here. Let me go all the way down. So here we got 4,200, and let's get that 4,100 here. So let me just zoom out for a second. Let me go here. Let me zoom out. So here we can note that we got this area here. So I'm just going to snap this, and you guys will understand a little bit better in terms of what the screenshots look like when I snap them. So again, right here, we got 410. Over here, we got 420. And what's notable to me is that the open interest and volume are roughly the same. Here we got about 21,000 at 4,100 and about 16,000 at 420. There's also volume on both. So for me, that means that this is a strategy someone is doing, right? It's the same thing for open interest, same thing for volume. And there's clearly a pattern here. So if we're going to get bearish move into Friday, we might be seeing some continuation. Looking beyond here, we can also note that there is a dramatic amount of puts all the way up here at roughly 45.10. So 45.10, 45.20. This right here is $1 billion in open interest. $1 billion. A big boy. That's $1 billion sitting right here. They haven't closed it out. It's been open for a long time, which to me means that they're deeply in the money. We also have a big puts right here at 45.20. There is some call flow. So like we can't say there's none, but I think these levels are not very achievable. I think it's a little bit of wishful thinking for the bulls. As we look further down as well, there's a secondary strike, which I'm noticing, which is very notable at 3,900 and 3,800. So looking over here, we got 3,800 and 3,900. This right here is 44,000, or the equivalent of about 440,000 puts. That is a massive amount. Looking over here, we got 3,900 as well. And between these two, I'm also noticing that it kind of looks like a put spread. So when we look forward to the bear level later, and again, there's 25,000 there, 3,800, right? Yeesh, these are big numbers. So the fact these numbers are so large tells me that the bears are well positioned and they're actually starting to claim victory on the chart. So as we move forward here, again, OpEx to quarterly tells me that the bears are going to be under some significant pressure as we go forward. April, again, relief rally on Russia and Ukraine. So the reason why I think we might get relief on this is because right now, again, if you listen to the FBI and CIA directors who all gave testimony this week, they all said that we're likely due for a couple more weeks. The worst is probably yet to come. And Emmanuel Macron, who was the president of France, also confirmed that when he had his phone call with Putin. We also note that we had a massive pump up on Friday when Putin told us that we were seeing some positive progression. And then, the Ukrainian foreign minister said, that's false. We're not actually seeing it, which makes it feel a lot like the U.S.-China trade talks where we're moving on headlines and it's very difficult to know what direction is. So I think that right now, the market is desperate for relief. I know that I would like to see some relief there. I think it's devastating what's happening. And I think that once we actually, again, I'll make this very simple to understand. The market loves certainty. So right now it is uncertain how this Russia-Ukraine tension is gonna wrap up, whether it resolves the way we want with peace or the way we don't with again something different. I don't want to say the word. Whatever happens, When the market knows what is likely going to be the future, again, the stock market being a future discount mechanism, it's going to try to pull forward what's going to happen tomorrow back to today. As of right now, I don't think that that is going to happen. I think that we need to see a resolution. And right now, we don't have a resolution. They're still fighting. And I'm a little bit skeptical. After that, I think the bulls and the bears are going to fight for direction. I still think we're in a dominant bear pattern. And what I would also note is that inside of bear markets is usually when we get some of the most violent pumps. So again, look what happened on Wednesday. Look what happened when we hit 410 the week before that. And if we actually get resolution in Europe, look what happened to the DAX. It was up 6% in a single session. That's a limit up and a little more. Limit up plus 50%, 6% in a single day. Incredible. So where we get that massive pump, I don't know. And who actually takes control after that, I also don't know. And again, these are new sections to the video. So if you're enjoying them, please make sure to show me some support by smashing the thumbs up and dropping me a comment to let me know what you think. Does it make it easier for you to make your plan and your trading plan for the week? Do you understand what I'm laying out? And now we're going to move forward to the bull section. Something new here as well. Again, I'm going to go through and provide the bull thesis. Instead of just talking about the charts, I'm going to tie it all together and tell you exactly what Professor Justin is looking for. So let's go over here. We got the Fear and Greed Index, then we got the 40% Club, and we're going to talk about those two first. So let's go over and have a look at those right now. So the Fear and Greed Index tells me that we've been, we were greedy a year ago. We went into fear, and now we're into extreme fear for more than a week. We were in extreme fear at 17. We went down to 15. Now we're down here at 14. And the reason why this is important to me is because I'm trying to understand whether or not the percent declines that we're seeing are actually justified. And the next thing I want to look at here is actually going to be three different sectors. So what I want to look at first here is going to be the Russian ruble. So we got the ruble versus the dollar. And when we look here, it is currently down by 40% year to date. So we look over here, it is down by 42% year to date. So again, potentially having WW, you know the final letter. I'm not going to say it. Negative 42%. I'd also note that this chart has not been healthy for a long time. Whoa, yucky! All right, look at that stinky chart. Started all the way up here at about 21 cents, and now it's worth a fraction of a cent. So this thing wasn't coming off a high base, and the precipitous decline is pretty bad. What I'm notably focused on here is the negative 42. The next thing I want to look at is going to be ARK. ARK is only beating it by 1%. It is down by 41 year to date. So you have to ask yourself, does that make sense? Should ARK be down by 41%? Should it be tracking roughly the Russian ruble, which is being shut out to be North Korea from the rest of the world? I don't know. It seems a little bit extreme to me. Finally, looking here at DIDI. DIDI is down 44% in a single session. Remembering, this is one of Jim Cramer's favorite stocks, right? Get as much as you can on IPO. That's what the guy said. Get as much as you can. If you can borrow or use margin, use margin, buy more. So 44% red here. So what I'm trying to show is that in a period of extreme fear, what I am noticing is that the risk of delisting means 44 additional red in one session. The risk of inflation being hotter than anticipated and growth not returning, negative 40% over the course of year to date. And then the Russian ruble, again, roughly a month, but year to date, it's down by about the same, about 40%. Is that extreme? I don't know. Even though these things were already deeply oversold, it didn't stop them from going lower. So what I want to focus on here is actually going to be emotions and how emotions drive the stock market. So looking over to here, this is something I prepared back on January 8th when I was talking about peak ARK. Again, this is when I was providing my bear market of 2022 thesis, and I was trying to find out whether or not, because I don't own ARK, am I seeing risk assets looking good or looking bad? So this is the psychology chart 101, which we always talk about. And at the time, I was looking for that slingshot up, the head and shoulders pattern, and then the low connect, giving us that red line right here, which is just above, I believe that's denial, where they say, my investments are with great companies. They will come back. And here's exactly what Cathie Woods was saying back in January. Cathie Woods says innovation stocks are in deep value territory. So where was ARK at the time? Well, it was trading here at about 84 bucks. We're not at 84 anymore. It is dramatically lower. So where is ARK today in terms of the pattern? Let's have a look. So in terms of the pattern and where we are, and I provided levels. So we can see that the pattern is still intact. We're down here at 55. So we're quite a bit lower. As we look forward, again, what's notable to me is that the next section here, let me actually just make sure I got my notes for the next section up. All right, here we go. Again, this was me back in January. I'm not thrilled, but it's hard not to see it. Where is support if this repeats? Previous launchpad and capitulation anger aligns with roughly 45 to 60. So that's where we are right now. We're between 45 and 60 here at about 55. So far, if I was going back and seeing whether or not my original thesis was correct, so far it is. I don't like saying this, by the way. I know people like innovation. I know people like growth stocks. I know that's what they largely own. And by telling you that the selling's not done, it can be a little bit devastating. So what I'm just trying to point out here is that I have been vulnerable to my emotions because I want to believe the world is going to go back to normal. I want to believe we're getting back to peace. But again, I'm not experienced enough to trade these massive geopolitical events to know that this is what the bottom looks like. So what I'm trying to do is defer to the charts, look at the emotion, and try to find out what's happening. So at the time, Cathie Woods was talking about, again, my investments are with great companies, blah, 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 right? Deep Valley territory. 40% compounded annual growth rate. The only other time in ARK's history was at the end of 2018. And again, we go 55 divided by 85 minus 1. Our stocks are down by another 35%. I don't know the bottom's in. If we look back here to where we are now, here is me giving my ARK update. And again, we're going to look here at my notes just because I want to make sure you understand where we came from and where we're going. So I talked about how the framework is laid out for us to either advance or plunge. We were now going down into panic where everyone says, shit, everyone is selling. I need to get out. If that's what you're thinking, that's probably where we are. And I posted this back in February, so about a month ago. About a month ago today. Again, the framework was there. Kramer loved her a year ago and hates her today. That was where I was saying maybe we can actually get a bounce here. However, ARK looks like the psychology chart 101. So when we look here at the 64%, 64.35 low before the dead cat bounce is the threshold for us to enter a panic onset. What confirms it? A weekly close below 64.35. And again, we actually closed below there last week. And if that was true, where I was looking for us to go was for, again, where do we dead cat bounce or wash out? Basically meaning where do we complete the pattern? That would be here at 37.55. It would be 77% off the all-time high and 42% off the Friday close, giving us our May 16th apex and our downtrends. And we're still on track. So as we have a look here, it tells me that, again, that's likely we're going to slide. So why is this a bull? Why is this bullish? Well, because, again, not that I'm saying it's bullish, but ARK being down as much as the Russian ruble being locked out of the world seems like an extreme move. The market can definitely stay irrational longer than you can stay solvent. So we have to take what we see with a grain of salt. And when the wheels are in motion, it's very hard to revert that. I'm going to talk about the 210s yields, and then I'm going to talk more about this when we get to the bear market section. So I want to talk about this because as we look forward to here, again, recession risks are piling up as investors need to get ready. So what we're talking about here is the U.S. Treasury yield curve has collapsed to near inversion, a situation when short-term rates exceed those of longer-term tenors, which has often preceded a downturn in Europe. Energy costs have climbed to unprecedented levels, and sanctions against Russia exacerbate a global commodity crunch. So what we're talking about here is that the gap between the 2 and 10s notes has been narrowing. Traded 1 year forward, spreads already show a curve inversion. So all that means is that the 2-year note here on the left-hand side and the 10-year note over here on the right-hand side show that they're currently at 1.75 and 1.997. So we have about 25 basis points here that is different. And the reason why this is bullish is because if Jerome Powell raises by 25 basis points, they will meet. They should meet at roughly 2%. Right? 10-year note will rise, 2-year note will rise more. However, if he raises by 50 basis points, we're likely going to see that yield curve inversion happen almost instantly. Why? Because it's too much differential. We're going to see that 2 over the 10, and that is a signal that Jerome Powell is very aware of that signals a potential recession ahead. So the reason why this is bullish is because Jerome Powell knows if this happens, it's not good. Again, over time, the 3 biggest factors that tend to drive the US economy into a recession are an inverted yield curve, some kind of commodity price shock, or Fed tightening. And again, right now, there appears to be a potential for all 3 to happen at the same time, which is why I think that Jerome Powell has the potential to dial back his narrative a little bit and see what could happen. Now we're going to look here at the QQQ daily death cross versus S&P. So going back to here, we got QQQ, looking at the daily chart. What I want to note is here's the death cross where we see the yellow line cross over the black line, or the 50 moving average cross over the 200 average. And what's notable about here is that we can see that when the death cross actually happens, we dead cat bounce up, form a base, and then we set what? A low, higher low, higher low. So even though we have the death cross, which is a lagging indicator, QQQ has been able to hold up those lows. It's not making fresh highs, but at least it's actually trending up. As we look forward here to SPY, again, for me, I'm seeing almost that same thing happening here, where we got the death cross, which is going to form probably in a day, if not a couple of days. There's our massive bounce. There's our base, and we have a slight uptrend. So this is not mega bullish. All it tells us is that if QQQ is leading S&P and it's going to reverse, meaning it's going to start dragging S&P up higher, if those lows hold, there is potential, keyword there being potential, that a bottom could be in. All right, next things to look at here are going to be the DAX versus the S&P, and then we're going to look at BTC versus ES. So going over here to DAX, S&P versus DAX. Over here on the left-hand side, we got the S&P. Over here on the right-hand side, we got the DAX. And the reason why this is notable to me is because looking here at a yearly chart where each candle is going to be the equivalent of 12 months worth of data, I would note here that the DAX is currently back testing. Let me actually delete everything on this chart over here to make sure that it's very clear as we go through. We can note over here that the DAX is currently red by about 14.2% year to date. The S&P is down by 11.5% year to date. So as people are selling their assets all around the world, they are buying up US stocks, which means that as they're fleeing to safety, America is more insulated in regards to the geopolitical events happening in Europe. They're not dependent on anything from the Russian economy. And if the DAX is forming a bottom, that likely tells me that the US can likely start resuming back up. I don't know for sure that this is the bottom, but when I look at the pattern, it's back testing a previous base here. So if this base holds, and as of the weekly close, we're back above 13,500, maybe that's it. So if the DAX is going to start resuming back up, getting back above the yearly open last year, roughly 14,000, that could actually drag the S&P back up higher. On the flip side, could also drag us down. So it is not the end all be all. It is just a pattern I am looking at. And then finally, we got BTC versus ES. So I showed this pattern before, and what I'm going to do now is show you the bull potential, and then we're going to go through the bear potential in the bear market section. So stay tuned. All right. So what I'm going to try to do right now is I'm actually going to do this here. I'm going to show you what I have over here, and this is shared on Slack if you're very curious about it. So instead of actually drawing the pattern, I'm just going to show you these because I'm already noticing the video's at 33 minutes. So for the bear case here, again, the bull case is the green line. The green line here shows us that we have 1, 2, 3, 4 legs down. This is the pattern that I use to predict the rally. So again, we had the massive rally here going into BTC, which dragged ES up 2 months later. And then we have the same pattern, 4 consecutive higher lows, 3 higher highs. Then we get our cup and handle fail, falling below the 50 daily, and then we plunge. So this was an excellent predictor for me to know that ES was going to get dragged up, ES was going to get dragged down. And now the question for me is it still the best leading indicator? As we noted before, Bitcoin is still down more than ES year to date or S&P. So if we're going to reverse, maybe we have a template here to follow. So we've had 4 waves lower. So again, that's right here where we see wave 1, dead cat bounce, wave 2, dead cat bounce, wave 3, wave 4, and then there's the move off the bottom. So if we're heading over onto the same thing here on ES, there's our first wave, second wave, third wave, fourth wave. If it's valid, we're likely in this section right here, which in this section right here basically means that we are below the green line. We formed our first relative low. We formed our lower low. So that's roughly where I think we are if we're currently in the bullish setup, which gets us roughly here if the pattern is correct. And if you look back to here, we zoom in nice and close. We'll just show it as an overview. So we get, again, plunge one. There's the ultimate low. We start grinding back up. And then as we look closer to here, over on BTC, again, what do we do? Well, we grind up. We have a big move lower, and then we pump. We got a big old pump. So as we look forward here over to the ES side, what do we got? Oh, yes. There's our big move down. So if we're bullish, maybe a little bit of a move into Monday and then up into Tuesday. If this was going to happen, I would be assuming it's going to be happening based on geopolitical tension easing, where we actually see some resolution between Russia and Ukraine. I don't think this is the base case. This is what I would see for a bearish setup, though. And this means we're ready for a massive rip. If this is going to happen, what it means is that we cannot afford to lose the lows. We cannot afford to lose the lows here at all. We cannot lose these lows. We have to keep driving higher. So even if we set a low next week, we can't fall below the low that we set on Wednesday. We can't, period. Moving forward here for the, I'm going to move to the bear case when we get to the next section here. So that's the bull case. All right. And then the quarterly close. So looking over to here for the quarterly close, I think I have one more here to show. Let me actually just make sure I actually have this up. 1 second here. I might not have this ready. I'm going to show one more section because my notes are already complete. So just hang on for 1 minute and I'll get this ready. Let's go to S&P channel. Let's go here to my SPY notes. And let's have a look here at my quarterly chart. All right. So here is my quarterly chart. And what it tells me is that if we're going to be moving higher, again, all we need to do is to look here and see that we push below the spinning top, which means we push below the high right here from the spinning top. We go down, we suck back up, we close above, we close below the spinning top level. We have a lower wick, which we already have formed here, which means even if we drive lower, we would come back up and save it into April. Then we got two patterns here, which show 2018 and 2020, where once we actually reclaim the real body close, we actually move higher. Into 2018 here, we can note that the close and open of the candles are at the end of the year. So we got Monday into Wednesday. In 2020, it's Tuesday and Wednesday for the 31st and 1st of March and April. We get a gap down, then we pump up. 1.6% gap down for 2018 and a 3.7% gap down for 2020. So if we get a gap down into April and then we also reclaim the close of the previous candle, which for us is going to be on the 31st of March, which is a Friday, on a Thursday, I believe. That is going to get us here to the bullish reversal. So that's what we're looking at. We have to close with a wick on the bottom into the end of the month, even if it means we push lower. We push down to 400. If we push down to 400, reverse back up to say like where we are now at 420, that'll leave a massive lower wick. That'd be the pattern fulfilling here. And then we cannot really dip much into the beginning of April, and we have to lift off. The easiest trade or the lowest risk trade is waiting for the new candle to form, which is going to be for the quarter and the month, and then it's reclaiming the close of the previous candle. There is tons of upside here between reclaiming the close and going to the high. So there you go. That is it for the bull case. And in regards to what I mentioned before, in regards to what's almost over, maybe now you better understand what I was trying to talk about last week with some more context and more understanding. All right, these pesky bears, right? These pesky bears. Oh, God. Why do they got to do this to us, right? Just leave the stock market alone. Looking here to our agenda, we're going to go through each one of these sections, which we've already touched on a little bit. So let's just move forward and see what it tells us. So S&P is closed in correction territory below 432 for the first time. Wednesday was the final day of quantitative easing. So let's look to S&P. Let's see what happened here. Oh my God, is that Wednesday? That's Wednesday. So I'm just going to jump forward here for 1 second to show what that means as we have a look forward here. The put is over. Fed buys $4 billion in treasuries Wednesday as QE comes to an end. The Fed put is over. So as we look back to here, whoop, There is our biggest rip that we saw going back to March of 2020. 10 points, 2.6%. Why? Fed was buying. Fed was out there buying. They bought $4 billion on Wednesday. So that is it. That's why we have that massive rip. And then when the liquidity is taking out, we faded. Do we have a recession ahead? We'll talk about that in a minute. The 2s, 10s, yields invert. We also briefly touched on that. We'll go back and talk about it for a little bit more. The TNX monthly chart doesn't look great. Fear and greed index. We're going to talk about the 40% club, the QQQ daily death cross, the DAX versus SPY, ETFs, trillion-dollar companies, OpEx, monthly, quarterly, BTC versus ES, and then the quarterly close. So let's go forward a little bit, and I will jump back to our agenda here. So again, what could go wrong? Well, more people think the Fed could get too aggressive than to do it too slowly, but roughly half of people, or 49%, say that the risks are roughly equal. And as we look forward to here, I think that what we talked about on the bear market of 2022 is that the Fed is currently battling growth. At the same time, they're trying to battle inflation. So because they're trying to do that, they're trying to decide which one's more important. And the risks of recession keep ratcheting higher. When we look here at the Fed balance sheet, as we noted before, if the Fed balance sheet stops expanding or the orange line stops going up, the blue line, which is the S&P 500, usually follows. So when we start going sideways, stock market goes sideways to down. When we start actually doing balance sheet runoff or reducing the number of assets the Fed holds, stock market crashes. They buy, stock market goes massively up. And this ended on Wednesday. So the put is over. The Fed has finished their buying. They bought $4 billion on Wednesday, and it is over. So this is the bear market template here. We're currently on track. We're down at 4,200, and we're only a few months into the correction. So 150 months of expansion. There's our 20 years of going nowhere. Potentially the same thing setting up here. I would also note that those strikes we looked at before in regards to the options chain, we looked at SPX. We were looking at what? 400, 390, 410 to 400, and 420 to 410, and then 390 to 380. Oh man, really? So they're already betting on those areas. There's 500,000 equivalent on SPY puts for 380s. Yes, that'd be a 20% drop, and that would be a bear market for the S&P 500. So what happens at 400 and where we go? Where we go after that, I'm not sure, but there's already the motivation for us to get down there to 380. So let's keep that in mind. I'd also note that when the Fed starts doing its balance sheet runoff, again, Nike swoosh, meaning they just buy like crazy. We flatline, they expand more. And here we are. There's the runoff. There's a runoff that we're basically looking at to set up right here. So Nike swoosh up, they ratchet up even higher, and then it starts to flatline. 2.5 years of expansion, 2.5 years of expansion, roughly 25% higher high. And I think we're setting up this period right here where they're going to want to try to reduce, but the market's going to have a sour reaction here. Again, in terms of this almost being over for the bear market thesis here, let's actually go back to our agenda, and then we're going to talk about all of these sections here one by one. So recession ahead. Let's go to our articles and see what that means. So let's go to the top here. Recession risks are piling up as investors need to get ready. So again, we talked about this before, right? Inversion in view. Gap between short and long-term yields has tumbled near recession levels. So we're almost at that area here. Over time, the three biggest factors that tend to drive the U.S. economy into a recession are an inverted yield curve, some kind of commodity price shock, or Fed tightening. Chief U.S. strategy, blah, blah, blah. Right now, there appears to be a potential for all three to happen at the same time. Yikes. Doesn't look good. And then we look at the 2-10s yield curve inversion. So we talked about this briefly before. Again, looking out on a forward-year basis, it looks like it's inevitable it's going to happen now. If the Fed hikes more than once, which they're going to, it's just a matter of when we're going to get that inversion, not a matter of if. We can clearly see that we're only off by, less than 25 basis points or 0.25%. It's a matter of when, not if. Moving forward here, looking at the TNX chart. So looking at TNX on a monthly perspective, which Bill Gross actually mentioned in that interview from Bloomberg, we're going to go here to TNX on the monthly. And as I look to here, there's a few things that I'm noticing. So first thing is that we have an inverse head and shoulders, right? There's our head into 2020. Our shoulder here is at roughly 1.4. meaning 1.4% or 14 on TNX. And then looking here, we have a 30-year plus downtrend going back to the late 80s to where we are now. And where are we? We're butting up right on that area, which means if we take out the high from the previous candle of roughly 20.6 or 2.1, 2.2% on the 10-year note, we're going to get a bull break, a 30-year bull break. In terms of years, it is actually specifically 33 years. I'm 33 years old. So I've never seen this happen before. All I know for the history that I've been alive is lower interest rates. Maybe we're going to see a shift. I doubt it. I think the market's going to break and it's going to cause the Fed to actually dial back a little bit. So that doesn't look nice. Oh, God. And the TNX is directly inversely correlated to the market. TNX goes up, stonks go down. Now let's look at the Fear and Greed Index. This exact same thing formed on BTC when we were actually going down to the lowest low. And then the fear actually did not drive us higher. It actually made us go down even more. So this fear and greed indicator here might not actually be our best gauge. And as we look forward to that 40% club, what I want to show again is that even if we are in extreme territory for being oversold, Ruble, US dollar, again, massive decline. It's been dripping down for a long time, but it didn't stop it from having a sudden 40% plunge. ARK, again, has not been hot. From peak to trough, we're now down by about 2/3 or 66%. It also did not stop it from having a fresh cut here just in the last 2 weeks of about 20%. So -40 was not really enough. When Cathie Wood said we were in deep valley territory, we're down by 35% more. And the most extreme example of fear, here's with DIDI. So DIDI is the poster child of being delisted, but every other Chinese tech stock was not spared, right? We saw JD, we saw Alibaba, all these stocks were down. However, this stock was down again on a daily basis. It was down by 44% in a single session, which means that from peak to trough, before we had this 40% decline, it was already down by 80. So being down by 80 did not stop it from driving down even lower. So again, in a single day, down by 44. So what I'm trying to point out here is that even though we say that QQQ is bearish enough, it's already been in a bear market, I don't know. From peak to trough on a closing basis, we're currently down by 20%, almost on the dot. So what I'm trying to point out here is that, again, drip, drip, drop, and then you get that big power dump down. So again, DIDI down 44% in one day. The Russian ruble is down like 99% from its high, but it still dropped an additional 40% in about 2 months. And ARK, even when Cathie Wood says we're in deep valley territory, 35% down more. So as much value as you think there might be out there in the market, not everyone agrees. And the resounding narrative I was hearing from managers, again, money managers coming on to Bloomberg this week was that I would not be selling into the weakness, but now is not the time to put fresh cash to work. Your dry powder. You want to keep that on the sidelines, wait for some early evidence we're going to be going back up, and then add. So if all these money managers, institutions are looking for reversal signs to add the cash, it means that as the Fed is removing accommodation, the self-fulfilling prophecy bearish might fulfill, and they're not going to put money to work, which means the bears will have an easier time claiming control of the charts. So again, that's not really that great of a setup. Looking here as well, we're going to jump forward to the next section now, which is QQQ daily death cross versus S&P. And again, the QQQ daily death cross happened right about 2 weeks ago, and it's likely going to drag S&P to have a death cross too. Those are double negative signals. They're usually lagging though, and they usually do not always happen immediately. However, what this tells us is that we're seeing the short-term price below the long-term price. The easiest way to understand why this death cross is so important is because people who have bought in the last 50 days lost more money than the people who bought in the last 200 days. This is becoming a self-fulfilling prophecy where people usually have a pain threshold. -5, -10, -20, -30%. So as people start hitting those stop loss areas or pain thresholds, and there's no buyers out there because everyone's waiting for reversal, and the Fed is taking their pedal off the metal, who's going to buy this? I don't know. It's the same thing when I talked about Bitcoin. Who's left to buy? My grandma? Who's left to buy stocks right now? All the institutions want to wait. DAX versus SPY. So again, looking back to the DAX versus SPY, my concern here is just that maybe this isn't it. If the DAX can't hold this 13,500 area and revisits, that's right. That's an engulfing bearish candle. S&P could do the exact same thing by power dumping all the way back down here to roughly 370 to go back to flat, reverse all of the gains from 2021 and get down into 2020 territory. So if we just repeat this candle right here, we get all the way down here to some of my lower bear market targets. And again, those lower bear market targets right now are here they're at 380 and then all the way down to 330, right? 336 would be a 30% drop. And then we get closer to those moving averages, which we also noted in this chart right here, where you start getting closer to that 50 monthly moving average and then those 50 weekly and 200 weekly moving averages. All right. So now, now that we understand top down, we've already looked at the heat map. Now what I want to do is I want to look at the individual ETFs which make up the broader market, meaning the sectors that drive the S&P. So let me actually put this back in full screen here. Not quite sure why I resized. Let's look at weekly charts now. So you'll note that there's no longer an uptrend drawn here because the dominant pattern is no longer up. It is sideways with a bearish pattern inside of it or us pointing down. So right here, the green line is support at 40.67 and our red line is at 454 with our head and shoulders. And then our pivot is at 441 with our 50 weekly moving average. So right now, the dominant pattern is down. I would also note it's the first week we closed below 432. The second thing is that we also have the second candle closing below. Actually, no. We've had four consecutive weeks closing below the 50 weekly. We didn't quite make it back up before here. So 4 weeks below the short-term price with a death cross coming. That is not nice at all. Looking at QQQ, we've had 1, 2, 3, 4, 5 weeks below the 50 moving average, pointing down, right? Looks terrible. And the dominant pattern is no longer up. It's actually down below the major green line. So we're probably going down to 300 here. That's where I would say the next stop is. Looking at XLF, again, 2 weeks below the 50 weekly. And it's going sideways. It's no longer trending up. So at best, the markets right now are going sideways, not up. XLV, healthcare, closing back below the 50 weekly, also going sideways. Looking at the Dow. The Dow here, again, 1, 2, 3, 4 weeks below the 50 weekly, and sideways is the dominant trend. Looking at the Russell, stinks, right? It's been below the 50 weekly for the whole year. It looks terrible. It's going sideways with legs down, right? Leg down, sideways, probably ready for a leg down. Back to the green line, 170. Moving forward to other areas like ARK, terrible, right? Oof. 1, 2, 3, 4, 5 weeks below the 200 weekly. Yuck. As we noted before, this chart seems like it is easier to go down than up. And then what's the other ones I want to care about here? So let's have a look at the 10-year note. So the 10-year note's actually ready for a bull break, right here at 20. Just like we saw in XLE, that exact same pattern where when it finally breached it, it lifted off, went to fresh highs. I think the last two we want to look at here, actually a couple more we want to look at. We're going to look at, NYSE, which is the New York Stock Exchange. And again, this is 2,000 stocks. So the Russell is, actually, I don't even know how many are in the NYSE. I think it's 2,000. I might be wrong. Russell 2,000. I think the NYSE has 2,000 too. But anyways, collectively between all these stocks or the composite, 4 weeks below the 50 weekly, no longer going up. It is going sideways to down. Why? We got a downtrend in our sideways action between the green and red line. Our SP or equal weight S&P, not very much better. We saved the 50 weekly last week by, actually, sorry, we did not. We lost it by about 18 cents and now closing a second week below. Again, also going sideways with a downtrend. So equal weight S&P is also soft. Last thing to look at is going to be our trillion-dollar companies. And then we're going to look at, again, OpEx we already talked about. We'll look at BTC versus ES, and we'll look at our quarterly chart to finish it off. So now, the reason why this matters is because we're going to be looking at the biggest companies, as we briefly touched on before, and we looked at the heat map. So let's go back to here actually and note what this looks like. So looking at the last 1 week, it's shifting more unanimously red. As we look at year to date, double-digit declines. And these are the last dominoes to fall for the market to drop because these are the heaviest weightings inside the market. Apple, as we can note here again, still technically trending up, still above its 50 weekly. It's the only other one. The only other one is actually NVIDIA. Every single other trillion-dollar company is below. I would note here that we spent 3 weeks basically opening and closing at the same price, which means they were able to control it. And this week, it power dumped. It opened up, pushed up slightly, and closed at the low of the week, a 10-point drop. Huge. Microsoft, second biggest stock. It is barely hanging on here. 2 weeks below the 50 weekly, 3 lower lows. It looks disgusting. It's not going to hold up. It doesn't look good at all. Looking at Amazon, even with the share split, which drove the stock higher intraday. Sorry, over here we went up as high as about 7.5%, but it didn't stop it from closing red on the week. It's got a doji here. It's way below the 50 weekly, and it's also making a fresh low like Microsoft. So already below the 50. Looking at Goog, again, 2 weeks below, and a kiss of death on the 50 weekly moving average here. So again, also same pattern. It's going sideways with a downtrend. Does not look great to me. What else have we got here? Tesla back below the 50 weekly. So looking here to Tesla, well, we can notice that it's still hanging on, but it is below the 50 weekly, and that is just not really a good look for any one of these stocks. Looking at Facebook, yuck. Right? Yuck. Fresh low, nasty candle, getting kicked out of Russia. Not nice at all. NVIDIA is the only other one that's hanging on. I'm talking by a thread. I'm talking 11 cents. Hung on to that 50 weekly moving average at 220.89 by 11 cents. Yuck. OpEx, we talked about it. It is bearish for the monthly and all the way to the quarterly. Not going to repeat myself. Let's go forward to the BTC versus ES template now. I think I have it over here. Here we go. So now we're going to talk about the bearish potential for the market here. And in terms of bearish potential, here's the bear case. So the bear case is that we're actually at the red arrow. We have a shooting star before the fattest drop that closed at the low. So if we move forward to here, what I'm showing right here is going to be this candle where we get our rip, we start fading back down, and we get a shooting star, which closes at the low, and then we proceed to have our biggest drop by closing at the low. You can note here, dead cat bounce. Here, dead cat bounce. Here, there's no dead cat bounce. It came later. We'll look over to this now. Oh my goodness. There's a rejection or an inverted hammer which has a higher high and a higher low to engulf the entire previous candle and closing at the low. For me, that would mean that if we're going to dive down, it's going to happen right into early next week. What would that be? Geopolitics, geopolitical tension. If it's still accurate, we also have roughly 51 bars from the dead cat bounce plunge to the low. So all I'm showing here is from the period where we have the low established and looking out to when the low gets formed here, it's 51 bars. It's 51 days because BTC trades continuously. However, because ES does not trade over the weekends, 51 bars would land us on roughly April 6th. So again, roughly April 6th. When I extrapolate this out, we're looking at about April 6th. And now talking about that quarterly chart, the reason why this is important is because that April 6th date is going to be into the first to second week of the new quarter. So if we have a look here, again, now I've revised this quarterly chart to give us a little bit more context. I have an uptrend drawn here from 2016 to 2018, same thing as 2020 to 2022. It's 2 years. Once we stop trending up, we start going sideways, we start going down. The notable pattern to me is this. We push below the spinning top. Right here, that's found on the beginning of 2018. We push below the spinning top. Same thing here, right? There's our spinning top in Doji, right? We push below, we close below the spinning top. We have a lower wick formed. Right now, this lower wick is not big enough. So it's okay, but we'd have to either suck up more to get closer to 430 into the end of the quarter, or we can actually push down towards 400 and then suck back up towards 415, 420 to form that lower wick. I also don't think that we're actually low enough relative to the low from the previous candle here. We're just barely below it. Here, quite a bit below. Here, quite a bit below. So that means the 400 test will be coming. Into 2018, we close, close of the red candle. So here, the reason why I'm pointing this out is because it closes and opens on weird days. It's not like on a Friday and opens on a Monday. So here, we close on Monday in 2018. We open on Wednesday after New Year's Day, which is a holiday. And what happens? A 1.6% gap down. In 2020, it closes out on Tuesday, the 31st, and then opens on Wednesday, April 1st. 3.7% gap down. This was during the height of the bad word. We all know what it was during March of 2020. So now what's going to happen is we're going to be closing out the month on Thursday, and then on Friday, the 31st, is when we're going to be having our. Let me see if I have my dates here I can bring up. So let's go back here for a second. So on Thursday, the 31st, we end the quarter. And then on Friday, April 1st, we open up the new candle, which means the new quarter. So I don't know, but it's going to be happening intra-week. And then if we're going to form this lower wick here, we did actually push down by a couple of points and then rally up. I could see that happening by, again, getting a final resolution on Russia and Ukraine into the weekend or the first week of April. And then when we come back to our trading desks, maybe we get a gap down pump up, and that is it. This has been a very long video. I think one of my longest ones yet. And I want to make sure that I've laid my thesis out clear. I want to make sure everyone understands what I'm talking about. And if you want any of these notes, they're all laid out on Slack. And like I said, there will be a video queuing up in a couple of seconds here, which is going to be my bear market of 2022 explained for more detail. And what I really encourage you to do is to be mindful this week that the risk is tilted to the downside. And if we're going to get that early feedback loop to go back up higher, we're likely, again, not a guarantee, but we're likely going to see that into the first week of April. And as of right now, that is 2.5 weeks away. So if you've enjoyed the video and you've watched all the way through, I would really appreciate a thumbs up and drop me a comment. It can be anything. I greatly appreciate it. And please also let me know about the new format. And again, you want to see that bear market video, it should queue up here in a minute or two. Thank you again for watching. I'll see you on Monday.